Everyone thinks the Great Depression started in 1929. Stock market crash, breadlines, Roosevelt's New Deal. That's the story we're told. But it's not the first time the world economy collapsed under the weight of its own illusions. 50 years earlier, in 1873, the world entered a slump so long, so strange, and so quietly devastating, it was simply forgotten. Economists called it the Long Depression. It lasted 23 years. The U.S. railroad boom went bust. Austrian banks collapsed. British industry slowed to a crawl. And Europe, already clawing its way into the gold standard, tightened the noose of debt, colonial extraction, and deflation for a generation. Yet here's the paradox. There was no official crisis, no singular moment, no Black Tuesday. In fact, GDP kept growing, and that's exactly what made it so dangerous. People thought everything was fine, until they realized prices were falling, wages were flat, debt burdens were rising, and money itself was being silently redefined, not by parliaments or presidents, but by bankers, creditors, and the gold bars in their vaults. Now fast forward to today, 2025. We're told the economy is resilient. Inflation is cooling. Stock markets are breaking records. But scratch beneath the surface, and the echoes of 1873 come screaming back. Once again, we have an expanding debt bubble dressed in the language of innovation. Artificial intelligence, green tech, digital currencies, they're the railroads and telegraphs of our time. Once again, we're watching central banks tighten liquidity in the name of stability, not realizing they may be locking in long-term decline. And once again, the winners are the ones closest to the printing press, not the worker, not the saver, not the real producer. The Long Depression didn't look like a crash. It looked like stagnation, declining margins, falling prices, collapsing farms, overbuilt cities, angry populations, rising empires, and dying republics. And just like then, the official narrative is missing the point. It wasn't a banking crisis. It was a monetary transition, from silver to gold, from expansion to contraction, from hope to arithmetic. That's the pattern we're in danger of repeating. Not because history rhymes, but because the mechanism was never dismantled. It was merely updated. To understand why 1873 matters and why 2026 may rhyme, we need to go back, not to the crash, but to the system before it, because every collapse begins as a solution. In the mid-19th century, the world was on fire with optimism. Railroads were the internet of the day, a revolutionary technology connecting continents, exploding productivity, and opening new frontiers. In 1869, the U.S. completed its first transcontinental railroad. Just 2 years later, the German Empire was proclaimed in the Hall of Mirrors at Versailles. Industry was rising, trade was globalizing, European empires were stretching like elastic across Asia and Africa. But behind the smoke of progress, a quiet battle was underway over the very definition of money. At the heart of it was silver. For centuries, silver had been the foundation of money in most of the world, from Spanish pieces of 8 to Chinese taels. It was the people's metal, more abundant, more flexible, more inflationary. It made expansion possible. It funded wars, built cities, and paid workers. But in the 1860s and 70s, silver's reign was ending, and not by accident. In 1871, the newly unified Germany, flush with French war reparations after the Franco-Prussian War, announced it would abandon silver and adopt the gold standard. That move sent shockwaves through global finance. Silver prices collapsed, and one by one, nations followed suit. Netherlands, Scandinavia, Austria-Hungary. The United States would make its fateful move just 2 years later, in 1873, with the Coinage Act, a law that sounded like a technical adjustment but functioned like a monetary revolution. They called it the Crime of 73 because that law quietly demonetized silver. It ended the free coinage of silver dollars and pushed the U.S. onto a de facto gold standard without a single vote from the American public. Overnight, the money supply shrank. Farmers who borrowed in silver-backed dollars but now had to repay in harder gold were crushed. Bankers holding gold-denominated bonds rejoiced. This was no conspiracy. It was a class shift. Gold rewarded creditors, deflation, and empire. Silver had fueled populism, inflation, and domestic growth. By switching to gold, governments were not choosing sound money. They were choosing sides. The side of London banks, Rothschild bullion dealers, and bondholders in Paris and Berlin. Why did they do it? Because gold was stable, predictable, elegant, and above all, international. With the rise of industrial capitalism and colonial trade, bankers and merchants needed a single, universal yardstick. Gold delivered that, at a price. Flexibility was sacrificed. Growth became dependent on mining output and central bank hoarding. And worst of all, debt became heavier. The amount of gold in the world was limited, but the amount of credit being created, especially by railroads, colonial expansion, and speculative banking, was exploding. It was a beautiful illusion: stable prices, global coordination, expanding infrastructure. But arithmetic can't be cheated forever. When credit grows faster than the base money that supports it, collapse is just a matter of time. We saw it in 1873. We saw it again in 1929. We are walking toward it now. Back then, they called it the discipline of gold. Today, we call it tightening liquidity. But it's the same idea, and the same class wins every time. When the system changes, most people don't notice until they can't pay their bills. If you're starting to see how monetary rules are written by the winners, share this with someone who thinks money is just a neutral tool. For a few golden years, it all looked like a triumph. The shift to the gold standard was praised as a mark of civilization, sound money, hard currency, a sign a nation had matured. Britain had been on gold since 1821 and ruled the seas. Germany joined in 1871 and became Europe's new industrial power. The United States followed in 1873, and investors poured capital into it like a rising empire. Money backed by gold was supposed to bring discipline, trust, and global integration. And for a time, it did. Railways stretched from Kansas to California. Telegraph lines crisscrossed Europe. Ships carried British capital to Argentina, Egypt, and Canada. The City of London became the beating heart of global finance, lending gold it didn't have to fund projects no one fully understood, in countries most investors couldn't even spell. Capital flowed like water, lubricated by faith in two things: gold and growth. Everyone believed the expansion could pay for itself. Borrow to build railroads, open up farmland, extract resources, raise productivity, and use the profits to pay back the debt. Simple, elegant, self-reinforcing. It worked for a while. American railway companies doubled in size between 1870 and 1873. Austrian banks loaded themselves with construction debt. British firms issued bonds to build cotton mills in India. Stock markets soared. Credit multiplied. And all of it was anchored to a monetary base that could not grow. Gold did not multiply like credit did. But as long as confidence held, nobody cared. That's what makes financial illusions so dangerous. They don't look like madness. They look like progress. Speculators became visionaries. Bankers became patriots. Debt became development. And money? Money became a promise, not a substance. You didn't need gold in your hand, just the belief that someone, somewhere, had enough of it to back the paper. But here's the catch. The price of that discipline was falling prices. As more countries joined the gold club, money supply tightened, but output kept rising, so prices fell for 23 years. Imagine producing more food, more coal, more cotton every year, but getting paid less and less for it. That was the logic of deflation. In a gold-based world, deflation isn't a bug, it's a feature, a cruel one, and yet the elites loved it. Because deflation makes money more valuable over time. If you lend $100 today and get $100 back in 5 years, but prices have dropped, you've gained purchasing power. In a gold standard deflation, creditors feast while debtors drown. By the early 1870s, the illusion was locked in. Economies looked like they were booming, but under the surface, pressures were building. Banks were overextended, farmers were overleveraged, and nations were increasingly chained to a fixed money supply they couldn't control. They called it globalization, but it was more like synchronized risk. One shock, and the whole thing could snap. It did. In May 1873, the Vienna Stock Exchange collapsed. What followed wasn't a sudden crash, it was something worse, a slow, grinding, invisible depression. But no one saw it coming. They were too busy celebrating the future. And that's the danger. When a system feels most invincible, it's often at its most fragile. It began not with a crash, but with a crack. May 9th, 1873, Vienna. The city was buzzing with capital, speculation, and imperial confidence. Then the Wiener Börse, the largest stock exchange in the Austro-Hungarian Empire, abruptly closed its doors. A major financial house, the KK Privilegierte Österreichische Kreditanstalt für Handel und Gewerbe, collapsed under the weight of its speculative railway investments. It was just one bank, one domino, but the cracks spread. Berlin followed, then Amsterdam, then New York. Railroad companies, the speculative tech darlings of the day, began defaulting. Bankers called in loans. Credit disappeared. And what had looked like unstoppable growth was revealed for what it truly was, a balloon filled with borrowed gold and blind optimism. The Long Depression had begun. But here's the part no one talks about. GDP didn't collapse. There were no fiery headlines of economic apocalypse. In many countries, industrial output increased. So how could it be a depression? Because people don't live in GDP charts. They live in wages, debts, food prices, jobs. And what they saw, year after year, was falling prices, shuttered businesses, and heavier burdens. From 1873 to 1896, prices in the United States fell by more than 30%. Not because goods were cheaper to produce, but because the money supply was fixed and credit was shrinking. Farmers in Kansas and Ohio were growing more wheat than ever, but selling it for less. Manufacturers in Manchester were producing more textiles, but profits collapsed. Overcapacity everywhere. Demand stagnant. Debt unpayable. In an expanding economy with a shrinking money supply, every unpaid debt gets harder. Every missed payment gets heavier. That's what deflation does. It doesn't just depress prices, it amplifies failure. And the system was designed to preserve the creditors. The gold standard didn't bend. It didn't accommodate. There was no QE, no central bank backstop, no monetary easing. Gold had no sympathy. If your reserves ran out, your economy choked. Period. In the United States, the anger boiled over. Farmers and workers formed new political parties. The Greenback Party demanded the return of paper money not tied to gold. By the 1890s, the populist movement was in full swing, with fiery orators like William Jennings Bryan, who famously declared, "You shall not crucify mankind upon a cross of gold." That was not poetry. That was arithmetic. Because the system worked, only for the top. The bankers in London, Frankfurt, and New York continued to collect their interest in hard gold. Colonial companies extracted wealth from India, Egypt, and South Africa to feed Europe's gold reserves. And the central banks? They weren't public servants, they were guardians of a creditor empire. Look closely and you'll see the same machinery today. When the math stops working, politics breaks. Austria-Hungary would never recover its pre-1873 glow. The U.S. saw labor strikes, monetary riots, and violent populism. Britain began its long, slow decline as new powers rose under different monetary rules. Because here's the truth. The collapse didn't happen in 1 year. It unfolded like a slow betrayal. A betrayal of those who produced by those who controlled the money. They said it was about sound finance. What it really was control. If this part made you question what a crisis really looks like, tell me how your country defines stability. Let's break the illusion together. They called it the Long Depression, but it wasn't just a phase, it was a reset. By the time it ended, the world economy had been reshaped. Gold had won, empires had hardened, and debt had become destiny. But perhaps the most lasting legacy was silence. Historians buried the story, economists waved it off, and policymakers decades later would fall into the exact same trap. Because once you understand what caused the Long Depression, the hidden monetary shift beneath the surface, you start to see it everywhere. You see it in 1929 when the U.S. Federal Reserve raised interest rates to defend the gold peg, tightening credit until Wall Street snapped. You see it in 1997 when Asian economies were forced to defend their dollar reserves, triggering the Asian financial crisis and IMF-backed austerity. You saw it in 2008 when credit markets froze and trillions in debt contracts, derivatives, and mortgage-backed illusions were exposed as structurally insolvent. And the solution wasn't healing, but more liquidity, more debt, and more power to central banks. And now, look around. As we approach 2026, the same mechanisms are humming again, but upgraded, digitized, globalized. The world is saturated with debt, over $300 trillion. Corporations, households, governments, all running on credit in a system still pretending it's backed by productivity. But it's not. It's backed by belief, by low interest rates, by the idea that central banks will always step in. We've replaced the gold standard with the central bank put, but the outcome is eerily similar. Widening inequality, speculative booms, zombie companies, and fragile trust. Today, we're not chained to gold. We're chained to liquidity. Since 2008, central banks have created trillions out of thin air. Quantitative easing, low rates, asset purchases. It worked, they said, until inflation returned. Now, since 2022, they've been tightening, raising rates, draining liquidity, trying to cool the economy, just like 1873. And just like then, the official narrative says it's under control. But the debt hasn't vanished. It's metastasized. In corporate bonds, in shadow banking, in government deficits, all resting on an illusion that growth will return before the math breaks. But real wages are flat, productivity is stagnating, and every rate hike makes repayment harder. Sound familiar? Back then, it was Kansas wheat farmers. Today, it's small businesses drowning in variable rate loans. Back then, it was railway debt. Today, it's commercial real estate and private equity. Back then, it was London gold. Today, it's Federal Reserve liquidity. The shell has changed, the logic hasn't. And again, the winners sit closest to the spigot. The top 1%, holding stocks, bonds, and real assets, have gained trillions, while renters, wage earners, and savers fall behind. And when the next tightening bites deep, the call will come. Stabilize the system, which means save the lenders. Again. This isn't a conspiracy, it's a structure, a machine, a feedback loop built not for justice, but for preservation. The debt is too large, the system too leveraged, and the money, once again, is becoming harder, not by gold this time, but by policy. Interest rates are the new guillotine. And that's why 2026 matters. By then, the illusion of resilient growth will collide with reality. The cost of debt, the drying up of liquidity, the cracks in the global supply chain, the politicization of money itself. The ghost of 1873 is knocking. But this time, the collapse won't come through telegraphs or stock tickers. It will come through defaulted pensions, bankrupt municipalities, unpayable student loans, and a loss of faith not just in money, but in the idea that the system ever worked. They changed the rules in 1873, quietly, to protect the lenders. They're doing it again. Systems don't collapse because of evil. They collapse when the numbers stop adding up, and nobody's allowed to change the rules. In 1873, the math broke. Credit had grown faster than gold. But instead of adjusting the system, they sacrificed the debtors, locked into contracts they could no longer honor, under rules they never chose. Today, we've done the same, just with digital ink instead of gold bars. We created trillions in debt on the promise of future growth, but the growth never came. Now, central banks are tightening again, liquidity is shrinking, and those promises, your mortgage, your pension, your national debt, are starting to look less like contracts and more like traps. Not by accident, by design. Because the modern economy isn't about production anymore. It's about preservation of capital, of leverage, of power. That's why every crisis response bails out the top, why inflation is blamed on wages, not monopolies, why the solution is always discipline, but only for workers, never for banks. You're not imagining it. The rules are different depending on where you sit. They said the gold standard brought fairness. It brought decades of silent suffering. They say central banks today are independent, but their policies still pick winners, still reward those closest to the money. So the question isn't if we're headed for another long depression. The question is, when the system demands its next sacrifice, who will it be? Arithmetic cannot be deceived, and history doesn't repeat, but it does leave instructions. If you followed about this far, know this: the past is not dead. It's just wearing different clothes. The ghost of 1873 lives in every tightening cycle, every liquidity drought, every widening wealth gap. But now you see it, and when the headlines start calling it a slowdown or a soft landing or just another cycle, remember, they said the same in 1873.